Welcome back to A&P Property Podcast. I am Anita, founder of A&P Buyers Agency, and if you're joining us for the first time, welcome. We have started this weekly A&P Property Edge podcast. Every episode, we tackle one big question that our clients are genuinely asking us right now. Today's question is one that I get all the time, and it usually sounds something like this. Anita, prices are insane. The market must be overvalued right now. Should I be even buying it now? And look, I get it. When the national median dwelling value has hit around 900k, when saving a 20% deposit merely takes 12 years and the rent have jumped 44% in 5 years while wages grew only 17%, it's completely reasonable to look at this market and go, something doesn't add up. So today I want to give you a real answer, not hype answer, not doom answer, a data-backed answer using the most current figures from ABS, RBA, APRA, OECD and Totality. And here is where I am going to land by the end. Yes, the Australian property market is overvalued on affordability metrics, but that does not automatically mean a crash is coming. Those are two very different things. So let's unpack that. Before we throw this word overvalued around, we need to be precise about what we mean, because it actually gets used in three different ways, and they are not the same thing. The first meaning of overvalued, relative to the income, which is simple. House prices have risen way faster than the household incomes. So homes cost more years of income than they used to. That's a fact in Australia is right now. The second meaning to the overvalued is relative to the rent. This means property prices have outpaced the income and the asset which it produces. Gross yield in some markets look compressed. For investors, that matters. In the third meaning of the overvalued, and this is the scary one, is the overvalued relative to fundamentals. This says prices aren't just expensive, they are being held up by optimism, speculation or the cheap credit, and they could fall sharply if conditions change. Now, here is the key insight I want you to hold on into. A market can be expensive for a longer time without collapsing, and the market can look overvalued on traditional metrics but still remain supported if the supply is tight, credit quality is strong and forced selling is limited. So better question isn't are prices high, the better question is are they unsustainably high? That's the question we are actually answering today. The affordability numbers are hard to ignore. Let's start with the case for overvaluation, because the data here is pretty confronting. The ABS just reported that total value of Australian residential dwelling hit $12.307 trillion in December quarter of 2025, and the mean residential dwelling price is $1,74,700. Think about for a second. Over $1 million national average for a country of 26 million people. And here's where it gets frustrating for the buyers. Wages are not keeping up the pace. So let's see the wage growth year to December 2025. It was 3.4% based upon the ABS news. National dwelling values year to Feb 2026 is 9.9% from Totality. National median dwelling value is approximately 900k. Now, property value is growing almost 3 times faster than the wages over and over again. And if we zoom out to 5 years, median household income growth 5 years to September 2025 is 20%. Median dwelling value growth for the same period is 53.5%. That's Totality own affordability analysis, and it's exactly why so many Australians feel like market is slipping further away even when they have the stable jobs and the decent incomes. The OECD doesn't pull back punches either. In their 2026 economic survey of Australia, they called out housing as increasingly expensive and placed Australia among countries where very high price to income pressure over the recent decades can be seen. Then there's a deposit problem. Saving a standard 20% deposit nationally now takes nearly 12 years. And even if you get there, servicing a new mortgage takes around 45% of the median household income. And for renters, it's not easier. Renters spending on their rent as a percentage of pre-tax income, which is 33.4%, which is record high. National rent growth for 5 years up to September 2025 was 43.9% and wage growth over the same period was 17.5%. So if your definition of overvalued is, do prices look stretched relative to the incomes, deposits and affordability? The answer is clearly yes. But overvalued doesn't mean a bubble, and the structure supports keep this market up. Here is where I see lot of people make a logical leap that doesn't hold. They go, prices are unaffordable, therefore the crash must be coming. That's too simplistic, and it can lead people to make terrible decisions, like sitting on the sidelines for years waiting for the correction that doesn't come while prices climb further out of reach. The market can be very expensive and remain firm if the underlying support is strong enough. And in Australia right now, there are several major support which is under the housing market. Say, like for example, support number 1, supply is constrained. ABS building approval data for January 2026 showed total dwelling approval fell 7.2% to just 14,564. Private dwelling including homes, which is down to 24.5%. Less supply being built, which means less stock coming on the market, which means continuous upward pressure on the prices and the rent. Support number 2, which we have seen, the population growth is still supporting the fundamental. Net overseas migration for 2024 and 2025 was 306,000 people who have come to Australia. That's still a huge demand input, particularly for rentals and the major metro markets. Again, the rental vacancy is extremely tight. SQM Research reported a national residential vacancy rate just hit 1.1% in February 2026. That is incredibly tight. National asking rent were up 6.6% over a year. When vacancy is that low, it's very hard for the property value to collapse broadly because there is a real occupancy pressure which will keep the demand alive. Now, the fourth point which support the fundamentals is the financial system is still holding up. This one surprised people. The RBI's 2025 Financial Stability Review said risk from the household lending remains contained. And APRA's December 2025 quarterly data, it is showing that the loans which are past due date for 30 to 89 days is 0.47%, which is down from 0.59% a year earlier. Non-performing loan ratio is 0.99%, which is down from 1.05%. Those are not the numbers you see before a forced selling spiral. So yes, affordability is weak, but the market is being held up by the constrained supply, strong population growth, a tight rental demand, and the banking system with relatively low arrears. That's a very different from speculative bubble. Expensive and stretched, it's much easier to defend than about to implode. Now let's talk about the interest rate, which is a big pressure point now. What higher interest rate do to housing? So now let's talk about one factor that can shift market sentiment fast. As of 18th March 2026, the RBI cash rate target is 4.10%, and we have had a rate increase in both February and March and expecting it in coming months as well. Higher rates hit housing in 3 different ways. Number 1, they reduce the borrowing capacity. Even if your income hasn't changed, you can now borrow less. They raise the repayment burden, especially for the variable rates borrower and anyone rolling off the cheap fixed rates. They change investor max. A property that stacked up lower rates might look very different now. But here is interesting, and this is something a lot of people miss. Higher rates haven't destroyed the housing market. Instead, they have created a divergence. Cotality February 2026 Home Value Index showed a clear split. Sydney and Melbourne were essentially flat. Meanwhile, mid-sized, capitalized and some regional markets were still recording a stronger growth. So, national story is no longer everything is booming. It's more like some areas still have momentum and others are bumping into the affordability ceiling. And that's exactly what you would expect in a market that's expensive but not collapsing. The biggest mistake investors make. This is probably the most important section for you if you are an investor. When people say Australian property market, they talk as if Sydney, Perth, Adelaide, Brisbane, regional WA, inner Melbourne apartments all move the same way. Actually, they do not. Even the Cotality latest data shows a massive variation. Stronger momentum in Perth, Brisbane and Adelaide, but softer in Sydney and Melbourne. The national result hides that spread. So when someone says Australian property market is overvalued, the right response is which part, which asset type and which buyer segment. Because one pocket can be genuinely overheated while other may be simply recovering from the weak period. So, think about this. A high-end Sydney market can be vulnerable to the reduced borrowing power and the confidence. And a tightly held affordable regional market with a low vacancy can remain resilient for much longer. A market with a strong investor demand but limited income growth may be more stretched. A market with major infrastructure, constrained listing and the rental pressure may still have support even if national affordability looks really bad. This is exactly why broad national headlines mislead people. The country can be overvalued as a whole, while individual sub-market offered very different risk to reward profits. And this is what we do at ANP. We get into the specifics. Now let's see what the regulators are telling us. APRA is already leaning against risk. Another reason I would be careful with the word bubble is what regulators are actually doing. In November 2025, APRA announced that from 1st February 2026, banks can only have up to 20% of new mortgage lending at a debt-to-income ratio of the 6 times or more. They applied this cap separately to the owner-occupier and investor lending. APRA was explicit. This move was specifically aimed at containing the housing-related risk from the higher debt-to-income lending. Think what it tells us. In an unchecked bubble, credit keeps expanding into the riskier territory. Here, the prudential regulator is actively trying to stop that build-up. That is not a behavior of a system in denial. APRA also noted in February 2026 that current high DTI lending level were still well below the cap, even though they were trending up. So the system isn't screaming distress, but regulators see enough heat to tighten it early. To me, that supports a middle ground conclusion. The market is stretched enough for regulators to worry, but not yet distressed enough to suggest a systematic unwind is underway. So now let's see the real investor examples and how it plays out. Let's take the case of the patient investor. We had a client, say her name is Sarah, who came to us 2 years ago. She had been reading headlines about the market being overvalued and was very, very nervous. But we weren't looking at Sydney or Melbourne for her. We were looking at the regional Queensland town with vacancy rate under 1%, median days on the market of 14%, gross yield 6.1%, infrastructure project commitment within 30 kilometers. She bought property for 380k, rented immediately at 450 per week, that is 6.1% gross yield. 2 years later, comparable properties in that suburb are selling for 430k to 445k. The national market was overvalued. Her specific asset wasn't, because we did the work to find the property for her in the right pocket. An example of another client, let's call him Michael. He had been sitting on the cash in his SMSF for 18 months. Kept saying, I'll wait for the market to correct. He was looking at the property in Western Australia. Median housing prices in that suburb was 520 then. Rental appraisal was 620 per week. Vacancy rate was locally was 0.8%. We ran the numbers with him. Even with the cash rate of 4.10%, the numbers worked with a buffer. Positive cash flow from day one. He bought 6 months in the comparable property on the same street was sold for 562k. That is 42,000 uplift in 6 months, not counting the rent he collected the whole time. The market being nationally overvalued is irrelevant to this specific deal. What mattered was the right asset, the right suburb, the right numbers, and the right time. Now, handling the big objections. But what if the prices drop after I buy? This is the fear underneath every hesitation, and it's a fair one. Here is how I think about it. We are not buying for 1 year. We are buying for 7 to 10 years for minimum. Over that time frame, Australian property has delivered positive capital growth virtually in every quality market, even through recession, rate hikes, and the global crisis. The risk isn't buying a well-researched property with the strong fundamentals. The risk is buying the wrong property because you rushed or because you waited too long and you bought at the panic price later. The market might go down. Shouldn't I wait? When the rates drop, prices typically rise. History shows this clearly. If you are waiting for the rates to fall and prices to fall simultaneously, you may be waiting for something that doesn't come. The real question is, do the numbers work today with the buffer? If yes, waiting is a cost and not a strategy. So is the market overvalued? Let's come to the question. Here is my honest answer. Yes, on affordability metrics, Australian housing market is clearly overvalued. Prices have massively outrun wages, deposits are taking decades to save, and renters are under record pressure. But this does not mean a crash is imminent. Supply is constrained, population growth continues, vacancy is at 1.1%, arrears are low, regulators are leaning in early, the structural supports are real. What this means for buyer is margins for error are smaller, quality and selection matter much more now than ever, cash flow matters, don't buy assets that can't service themselves in this rate environment. Borrowing buffer matters. Don't stretch to the absolute maximum. National headline don't tell you whether your specific deal is good one or not. So here is the real takeaway from today's episode. The Australian property market can be both too expensive for many households and still supported by real structural demand and constrained supply. That's why it confuses so many people. They expect overvaluation to lead immediately to collapse, but sometimes overvaluation leads instead to something slower, a market that becomes harder to enter, harder to outperforming, and much less forgiving of mistakes. And for serious buyers and investors, that means one thing. You don't win by buying any property. You win by buying the right property in the right location with the right numbers at the right time. That is exactly what we help our clients do at A&P Buyers Agency. We are not here to hype the market. We are here to help you navigate it with the data and strategy. If you want to have a conversation about where your opportunity actually sits right now based upon your budget, your goals, your timelines, reach out to us directly. If you found this episode valuable, please share it with your friends who is trying to make sense of the market. See you in the next episode. Until next time, make smart decisions.